Hey guys, so I want to do a quick little video on the methods in which I invest. So I've been investing for a little bit over 10 years now, and these methods that I use have brought a lot of success to my life financially, and they're very, very simple. These methods aren't any secrets. These are the methods that Warren Buffett uses, Charlie Munger uses, Ray Dalio, some of the best investors in the world. And essentially there's three things to keep in mind when investing. One, long-term play. It's a long-term strategy. You think of 20, 30, 40, even 50-year strategies. Two is you want to strategically diversify your portfolio. Strategically diversify your portfolio. There's a big difference between just diversifying and strategically diversifying. Just diversifying for the sake of diversifying really won't give you really good returns. Third is consistently invest. So consistently invest. So those are the three methods in which I've invested, which some of the best investors in the world have invested, and which I completely am sold out to based on my success. So I can break it down. I'll break it down as simple as I can on those three methods and explain a little bit further. So the first one is long-term play, and a lot of people probably don't like that idea of long-term play because, like, well, that'd be cool to be a millionaire when you're, but I'll be like 65 and I won't blah blah blah. Well, the thing is, it's yes, part of that is true, but the other thing is the strategy behind it could make you wealthy sooner. And the strategy behind it is the long-term play, which is mitigating your risk. Mitigating your risk will produce larger returns. And what I mean by mitigating your risk is essentially making investments that will give you good, healthy returns, whether the market is up or the market is down. And the best way to do that is by investing in S&P 500 index funds. I'm a firm believer in that. They've produced the best results historically and have beat most financial advisors or day traders, or they beat the average mutual fund that's invested in all these different types of these different types of investments, and they're managed by these so-called financial gurus. And no disrespect to those financial gurus, that's fine. That's how they make a lot of money, and they use a lot of strategy. They use a lot of data to make their decisions. However, the S&P 500 has always beat them over time. Over the long term, they've always won. They've always had better returns. So that's the long-term play, is you just have better returns with the lower downside of potentially having huge losses also. Because you could easily have someone that says, oh yeah, I've made 30, 40, 50% returns, but they could be talking about 1 year. Yeah, 1 year I made 30, 40% return, and then the following year, they won't tell you about that they lost 30 to 40% of their return. So, so again, long-term play, S&P 500 index fund. The second thing is, it actually ties in with S&P 500 index fund, is strategically diversifying. Now, over diversifying or diversifying spread out way too thin could reduce your returns. And the S&P 500 index funds are invested in the top 500 large cap companies in the country, and these companies are successful. These companies are what typically, or what actually they're driving our economy. They're the ones that are producing and are the heavy hitters when it comes to our economy as far as companies are concerned. So investing in those companies is a good idea because they're already diversified. You're investing in all 500 companies, and you think of it as you own those 500 companies. So that's the diversification, strategically diversifying. And lastly is being consistent. So what I mean by that is, so if you are investing, right, and let's say you put down $10,000 and you invested in 2007 and you invested in S&P 500 index fund, and the market crashed 2008, 2009, and the market crashed about 35% drop. The Dow Jones just dropped significantly. You would have lost $3,500 minimum. And most people emotionally, they see that and they're like, oh my gosh, they get scared and they pull their money out. Well, you just lost a big piece. But consistently investing, meaning if, like, let's say you invested the $10,000, but at the same time you are also investing about $100 a month, and you bought stocks every 3 months or so of S&P 500 index fund, and you kept investing even in the downturn, right? So you would have lost, in that case, $3,500, but you kept investing month after month or quarter after quarter every 3 months. You would have gotten that stock at a value. You would have gotten that stock at a very good price. So when things came back up, which they did within about a year and a half, things started going up. Not only would you have gotten your $3,500 back, but the money that you invested consistently would have given you 35, 40, 50% returns by the time the year and a half was up, if you just held on and if you weren't emotional, you did not get shaken up by the downturn, you would have came on top. Then of course, if you would have kept it another 5 years, you would have tripled, quadrupled your investments, especially if you were continuing to invest. So that's essentially the three strategies, the three areas on how I invest and have invested for the past 10 years, more consistently in the past 8 years, and has proven to make me very successful. So that's all I have. Hopefully this helps someone. I try not to make these videos too long. I know I'm leaving out a lot of other information, but hopefully this at least gives you an idea of the methods in which how I invest. Hopefully this helps someone. God loves you. I love you. See you next time.